Hey students, welcome to week 5 of Accounting Principles. I hope all is well with you. Listen, we're just at the halfway mark as of this week, including this week. We have 4 more weeks to go. Well, listen, we've put chapter 1 in our rearview mirror, and so it's on to chapter 2. And we'll be in chapter 2 for this week and for week 6. During week 7 and 8, we'll get into, but we will not finish chapter 3. So listen, the math gets a little bit steeper from here on out. For example, in the assignment for this week, you're going to be creating T-charts for a small proprietorship business. I've attached a spreadsheet to the assignment to help you along. Complete that spreadsheet for your assignment and then upload it back into Canvas for your submission. Should be easier for you that way. Let's talk about this week's objectives. One of this week's objectives is to learn about the 3 measurements that must be resolved before an accounting transaction is recorded. Those 3 measurements are recognition, valuation, and then classification. The recognition measurement answers the question, when should the transaction be recorded? And the valuation measurement asks what dollar amount should be recorded. And then the classification measurement identifies which accounts are affected. Let's take a little bit deeper dive into each one of these. You know, a sale is recognized when the title to merchandise passes from the supplier to the purchaser, and regardless of when payment is made or received. Again, it doesn't matter when payment's made for an item, the date of the sale is recognized when an item is transferred from the seller to the buyer. This is called the recognition point, and it's recorded as a date or a time, and sometimes both. Look on your receipt the next time you go to the grocery store. The date and time stamp on that receipt is the recognition measurement for the sale. Regarding the value of the transaction, or it's called the valuation, the dollar value of any item involved in a business transaction is its original cost. The practice of recognizing the value of the original cost for an item when it's transferred from the seller to the buyer is preferred by accountants because the cost is verifiable and it's objective. The original cost results from an agreement between the buyer and the seller, and it can be verified by evidence created at the time of the transaction or the time of the sale, like a receipt. And the third measurement of an accounting transaction is that of classification. Every business transaction is classified by means of categories called accounts. Each asset, liability, owner equity, revenue, and expense has a separate account. Any and all accounting transactions must fit into an account defined on the chart of accounts. Check out Exhibit 2 in Chapter 2 for an example of a chart of accounts for a small business. Okay, 2 more objectives this week to learn about. T-charts and the double entry method that are used in accounting. First, let's review what an account is. Accounts are the basic storage units for accounting data and are used to accumulate amounts from similar transactions. So, all rent expenses, for example, would be a basic unit of accounting. They're all gathered together into an account. All revenue from the sale of services would be another basic unit of accounting. And all of a company's accounts are contained in a book called the General Ledger, sometimes called just the ledger though. An account in its simplest form, it's called a T account or a T chart, and it has 3 different parts. It has a title, which identifies the name of the asset, the liability, or the loaner or the owner's equity account. There's a left side, and then there's a right side. The left side is called the debit side, and the right side is called the credit side. In other words, it looks like a capital letter T. Okay, and across the crossbar, there's the name of the account or the name of the T-chart account, and then that vertical line on the T would separate the debit side or the left side from the credit side, which is the right side. In Chapter 2, Section 4, it goes through the T account structure. I've also attached a link for some supplemental literature that I found in a website. You can find that link in this week's section on Canvas. It's titled Materials for Success. As important to the account structure is the system of double entry accounting. The double entry system of accounting requires that each transaction be recorded with at least 1 debit and 1 credit It's a matching, one debit, one credit, and that the total dollar amount of the debits must equal to the total amount of the credits. So that means for any one update of a T-chart, you must update another T-chart. And one of those T-charts is going to be a credit T-chart, and the other one's going to be a debit T-chart. All debits must equal to all credits. And just a note about debits and credits. In our society, we tend to have positive views about that word credit, while we have negative views and connotations associated with the word debit. Well, dispel that societal belief when you're talking in accounting terms. In the world of accounting, debits and credits are simply a way to organize the valuation of transactions. And there are some meanings behind the words debits and credits in accounting. And you can read about the history and background of why accountants use those terms to record transactions. It's in an article that I included in the Materials for Success area in this week's Canvas material. All right, that's it for now. Make sure you read the details for Chapter 2, and we're looking at sections 1, 2, 3, 4, and 5 in your copy of the text. I'll be available during virtual office hours on Tuesday evening at 6 o'clock your time, Mountain Time. Contact me with questions. If you're struggling with this math and the concepts of this class, please be sure to reach out to me. Contact me. I want you to be successful. All right, remember, God is on his throne. He's always been there, and he always will be.